US stock markets have entered correction territory. The S&P 500 index is down 10% over the past month. The Nasdaq 100 has fallen 14%, and the Russell Small Cap Index has fallen 19%. Some of the hardest hit stocks include the Trade Desk, down 62%, restaurant business Cava, down 57%, and Robinhood, which has fallen 46%. And there are two key reasons for the volatility. The first is that coming into this year, US stock markets were already extremely expensive. The Shiller PE ratio was at 36, and the market cap to GDP indicator was at levels last seen during the dotcom bubble. Warren Buffett's cash pile had soared to over $300 billion. The second reason is economic uncertainty caused by the new US government. President Trump has installed tariffs on most of America's trading partners, stirred geopolitical tensions with Europe, and aided by billionaire Elon Musk, begun cutting federal spending and government jobs. These policies are mostly recessionary because they raise costs and hurt demand. Oil prices have fallen 20%, and last week the Bank of Atlanta Fed said that US GDP could drop 2.4% in the first quarter. Crucially, Trump appears to be unfazed by the volatility in the market. The question is why? One reason is that the US government holds a significant amount of debt, over $36 trillion, which has the potential to cause a debt crisis further down the road. This debt has accelerated since COVID and is costing the government over $300 billion a quarter in interest payments. Behind the scenes, Treasury Secretary Scott Bessent has been plotting how the US can reduce its debt pile without destroying the economy. Bessent's plan is to divert resources from the public sector to the private sector, cut government spending, and bring in additional revenue from tariffs. In other words, reduce money going out and increase the money coming in. However, this approach is also high risk and finely balanced. Spending cuts will reduce demand, which should weaken inflation, bring interest rates down, and make US debt more manageable. But weak demand will also hurt company profits. Global trade will suffer and unemployment could surge. In other words, deleveraging the public sector could lead to a much sharper recession than desirable. Crucially, Trump and Bessent don't seem to be worried about volatility in the market. Bessent said that the US economy may need a detox period, and Trump has effectively said that some short-term pain may be necessary. Zooming out, the US stock market still isn't particularly cheap, even after the recent sell-off. That means investors don't need to be in a rush to jump in. Market volatility is likely to continue over the next few months, and there are bound to be some interesting opportunities that come up. And if you want to hear about some of those opportunities, make sure to join my newsletter at 3minutebreakdowns.com. But these are my personal opinions, not financial advice. Thank you for watching.